Hi, I'm Pattu from FreeFinCal. Many investors believe that overnight mutual funds have no risks associated with them. That's not true. We have talked about what is known as reinvestment risk earlier at the short end of the bond duration spectrum, and overnight funds also suffer from these, as we shall see presently. Before we begin, a couple of announcements. One is that I have a lockdown offer going on the goal-based portfolio management Lexus series. You can get 1000 rupees off. That's a 39% discount. So the price would be 1570 only. You can get it until April 14th, until the lockdown is over. Hopefully, I'm assuming there will not be an extension of the lockdown. Anyway, that's the deadline. 14th is the deadline for this discount offer. I'll leave the link in the first comment. You can also see it in the description. You can take the offer, and it's essentially a series of lectures that will help you manage your portfolio better in regardless of what the market returns are, up, down. The idea is to get a target corpus, and we'll talk about methods on how to do it. Many members, we now have about more than 1300 people in the group, in the exclusive Facebook group for this lectures, and many members have started developing their own portfolio trackers based on these videos. Also, yesterday I talked about the EMI moratorium calculator. I have uploaded a new version for this, version 2 for this. In the first version, all you could do was set 3 EMIs to be 0. That is, you can take a 3 EMI holiday, but now you can now take a 1 EMI holiday or a 2 EMI holiday. In version 2, you can use this, and this you can set any month to be 0, however way you want to play with, of course within the rules as it's allowed by the bank and so on. So please download the second version and have a go at it. If you are interested, share this link to others who are interested. Alright, so let's get back to overnight mutual funds. So overnight funds essentially mean that they are going to basically invest in what is known as an overnight bond, and this is done in the by the Clearing Corporation of India, what is known as a tri-party repo arrangement. I don't want to get into the details of it, but what it means is that you give cash to to somebody who wants money, and they will give it back to you tomorrow with a little extra. And this is done with a collateral, given a collateral of government securities and so on. So that's why it's called the tri-party repo. So the Clearing Corporation of India will act like a mediator between you, which is the mutual fund which gives money to, and the company which wants money, and that's why you have a tri-party agreement. So in the case of a mutual fund, the portfolio of in the case of the overnight mutual fund, the portfolio of the overnight fund will change every day because the bonds are just having a maturity of 1 day. Now, this kind of fund has got very little credit risk because it's done with the collateral, and then there's a third party which is organizing it. And also the interest rate sensitivity will be low. That is, when what happens is when interest rate rises, then the new bonds will have more interest rate. So the value of the old bonds which the mutual fund has will be lower, and the NAV will come down. That's called interest rate risk in mutual funds. However, for overnight bonds, the next day the bond will expire. So that kind of loss because of interest rate changes or gains because of interest rate changes will not happen. However, there is a very different kind of risk called reinvestment risk, and that's what we are going to talk about in this video. What you see here is the NAV of Kotak Overnight Fund. You can see that the NAV is moving up like this, and then on March 23rd it started moving down, up in a much slower pace at a much slower slope. So the returns have suddenly changed. So this is the risk that's happening in overnight mutual funds. That is, it will not have capital loss like what we saw in liquid funds. In liquid funds on March 23rd or so, I had discussed in a video where there was actual loss because suddenly investors pulled out money from the liquid funds, from the short-term bonds, and because of that the yield shot up. So the price went down, the yield shot up, and because the price went down, because of the lack of demand, then the liquid fund NAV fell down, and RBI had to buy some bonds to take care of that because there was too much of bonds available. There's no demand at all, so RBI had to purchase some bonds, and then only the NAV corrected, and then it moved up. that's the risk in the interest in liquid funds which has got bonds up to 3 months. In the case of overnight, what happened is same thing. The demand suddenly vanished. Too many bonds were in the market. RBI had to buy some bonds to reduce the demand, and also the something known as the reverse repo rate was also reduced by 0.9%. Reverse repo rate means this is the rate at which institutions can give the money to RBI. The RBI will act like a bank. They will give the money to RBI, and the RBI will pay them the reverse repo rate. That rate reduced by 0.9%. That's a huge reduction. That is the reason why the NAV came down. So only people who don't have, who want very very short term needs, they will use this tri-party repo, because the rate has come down significantly. And if they want to park money for even for 1 week or 2 weeks, they will choose something a longer duration bond, and they will not choose the overnight fund, because the interest rate has come down significantly in the 1 day bond segment. And because the interest rate has come down significantly, and because the so one day the interest rate was high, and the next day the interest rate was low, and the next day the overnight funds bought those new bonds immediately. That's called the reinvestment. They reinvested from a high interest rate bond to a low interest rate bond, and therefore the NAV started moving at a much slower pace. This is called reinvestment risk. There is no loss of capital. The NAV did not fall down. That is, the daily return did not become negative. However, the rate at which the return moves up has slowed down significantly, and that's called reinvestment risk. Because one day the fund was holding a high interest rate bond, next day the interest rate became significantly lower, the 1 day bond interest rate became significantly lower, and they had to buy that because they are an overnight fund. Every day the portfolio changes, and therefore the NAV fell down. So if you actually look at the numbers, this is the 7-day return. I have it, you may not be able to see it in the video, I'll just explain it. For the 7-day week starting from 16th March 2020, the absolute return was something like 0.9% or so. But then for the 7-day week starting from 23rd March 2020, the 1 week absolute change in return fell down by as much as 5%. It reduced by 5%, 10%, 8%, depending on what bonds they were using and so on. So there's a very big change in the weekly returns of overnight funds. So going forward, overnight funds will offer much lower returns for some time, for some weeks or months, depending on how the market situation pans out. So this is called reinvestment risk. I talked about this in short-term bond choices for investors, and there's no risk of loss. But then if you expect a return from an overnight fund if you expect 6% return from an overnight fund, that's not going to happen going forward. It's going to only give you about 4%, 5% maybe, depending on the bonds it's invested in. It's going to become very close to an SB account. So if you expect high returns and invest in overnight funds, you will be disappointed because of the reinvestment risk. So that's what I wanted to say. Bye bye.